All right, guys, it's Stackmode Chris here. Today we're going to be talking about the cover calls in the Iron Condor. We're going to understand how these market structures work. We're going to deconstruct the mechanics and the risk profile of the cover call. We're going to analyze the structure, profitability, and adjustment techniques for the Iron Condor and determine the appropriate market environments for deploying each strategy. Okay, let's go and let's jump straight into it. So, the cover call is perhaps the most fundamental income generating option strategy. It involves holding a long position in an asset, like 100 shares of stock, for example, and simultaneously selling a call option against that same stock. The term covered is the key, as your long stock position acts as the collateral. And the goal of it is to generate premium income, right? To generate some cash flow against a long stock position, essentially lowering your net cost basis in shares. And it performs best in neutral or slightly bullish markets in general. So let's talk about the two-part mechanics, right? It's a two-part trade. So leg one of the trade is, let's say you're long. So you would have to buy at least 100 shares of the underlying stock, okay? Whatever that you wanted. And then leg two, you would short. Then you could sell one call option contract, which would represents 100 shares. So a call option contract represents 100 shares. Same thing with the put option. It represents 100 shares per contract against the long shares. So we'll talk about the strike price and expiration. So the call option is typically sold out of the money, meaning that the strike price is above the current strike price. So it usually has an expiration date between 30 and 60 days out, and this balances the maximum time decay benefits while minimizing the chance of early assignment. So the key concept of it, right, is capping the upside. So by selling the call, you're going to be granting someone else the right to buy your shares at the strike price in exchange for the premium. So you agree to cap your potential upside profit at that strike price if the stock rallies significantly. So understanding the payoff structure is going to be vital for proper application. So the premium received shifts the entire risk reward profile. So it turns a traditional stock holding into a defined risk income vehicle. So let's talk about the max profit, right? So the max profit. This is realized if the stock closes exactly at or above the strike price at expiration. And the break-even point is the original stock purchase point. So the premium acts as a buffer against the decline in the stock's price. Okay? And as far as the risk involved into it, right? So the core risk is that the stock rallies past the strike, right? Let's say in hindsight, that would lead to your shares being called away, a sign at the strike price, forcing you to sell them and forego further upside. So, as far as downside exposure, the strategy still retains the full downside risk of owning the stock, minus the small premium collected. If the stock falls drastically, then the loss would be significant. And if the stock price Gotcha. So if the stock price approaches or crosses the strike, a common adjustment is to roll the option. And this means buying back the currently sold call, right, for closing it, and selling a new call with a later expiration date and or a higher strike price. And this action can often be done for a net credit, extending the trade and potentially capturing more upside while avoiding immediate assignment in general. So the Iron Condor, it's a sophisticated non-directional strategy and is designed to profit from a stock remaining within a defined price range over a specified time period. And unlike the covered call, the Iron Condor defines both maximum profit and a maximum loss at the outset, making it a pure defined risk trade. So as far as the market view, right, strictly neutral or low volatility, and you're betting that the market will not keep that in mind. You're betting that the market will not move significantly in either direction, up or down before expiration. You're thinking that the market's going to remain pretty flat. So structure. An Iron Condor is essentially two separate credit spreads combined on the same underlying asset. So a bear call spread, right, for upside defense. Okay. Because you sold out the money calls, plus you bought further out the money calls. Okay. So you could do things like that. And let's say a bull put spread, okay, for downside descent. Let's say you sold out the money puts, plus you bought further out the money puts, okay? Building that defense, building that buffer. So the goal is to maximize the premium received from selling two inner options, right? It's the body of the Iron Condor. And it's minimizing the cost of the two outer options, right? It's the wings which define the maximum risk in general. And let's talk about the power of time decay, theta. So if you're an options trader, you guys may have gotten destroyed by theta before. You might have been up some good profit at a point of time, and then your trade just absolutely plummeted down to the ground because you didn't close at a certain point of time, right? And that's because of theta. Theta is going to be part of the Greeks in options, and it can be something that can make or break a really, really good trade. So keep that in mind, and make sure you guys are buying months out whenever you're buying options, at least months out to years out. And the strategy thrives on the erosion of option value due to the passage of time. And since you're a net seller of options, since you're a seller of options where you're collecting the premium, you benefit directly from theta decay, which is accelerated in the last few weeks before expiration. So if you're selling options, then I recommend you guys have lower expiration dates, because you're betting for people to take wild bets and for them to lose. But if you're buying the options on speculation, I recommend you guys buy many months out. So this is the reason why it works, because people who don't know that, who don't know about theta, you're pretty much taking gamblers' money. So anybody who wants to gamble and bet market in wild ways and wild numbers, with wild expiration dates that are really close, you would go ahead and exchange money with them fairly. And to fairly grasp the iron corridor, you must see it as 4 distinct transactions working together to create a single bounded payoff zone. And each leg is going to be crucial for defining risk and maximizing credit. So let's talk about the call side, right? The bear call spread. So a short call, it sells premium and initiates the upside profit boundary. And a long call, it buys cheap your premium and it defines the maximum loss on the upside. And the purpose of it, it protects against a large move up, defining the risk to the upside. And let's talk about the put side, right? Puts is going to be if price is going in a downwards direction. Calls is going to be if market wants to go in an upwards direction. So short put, it's where you sell premium and initiates the downside profit boundary. And a long put, is where you buy cheap your premium and it defines the maximum loss on the downside. And the purpose of it, it protects against a large move down, defining the risk to the downside, preparing yourself. So max profit condition. So the maximum profit is simply net credit received when initiating all 4 legs. And this maximum profit is achieved if the underlying stock price closes between the 2 short stock prices. All right, so the short call and short put at expiration. And in this scenario, all 4 options expire worthless and you keep the initial premium collected. So the Iron Condor's defining feature is that the risk is fixed and known before the trade is placed. And this is fundamental to professional portfolio management. So the max loss calculation. The maximum possible loss is determined by the width of one of the credit spreads, and a call spread width or put spread width minus the net credit received. So for example, if the call spread width is $5 and you receive a $1.50 credit, right, the max loss would be $5 minus $1.50. So that would equal $3.50 per share, or $350 per contract. Because remember, for options, whenever you have decimal numbers, you gotta multiply them by 100. So that's just doing the math by that. And the upside break even, let's talk about. So short call strike price plus the net premium received. If the stock closes above this point, then the trade would lose money. And downside break even, right? Short put strike price minus the net premium received. If the stock closes below this point, then the trade would lose money. And the safe zone, the profit tent is going to be the area defined between 2 break-even points. And the wider the distance between your sold strikes, the wider the tent. Compared to the width of your protected wings, the larger your potential profit, but the lower of your probability of success. So keep that in mind. So those strategies are going to be crucial for a well-rounded option trader, but they're going to go ahead and serve entirely different purposes and thrive in different market cycles. So we'll talk about the Iron Condor versus the covered call. For the market bias. Neutral to slightly bullish. And Iron Condor, strictly neutral. Risk for covered call. The stock downside is going to be uncapped. But for an Iron Condor, the risk is going to be defined and limited. Big upside here. And the max upside, capped at call strike price. But the Iron Condor is going to be capped at the net premium received. And the primary benefit for the covered call is going to be for consistent cash flow for a low cost basis. But the Iron Condor is going to be a high probability of small profit, building a consistent, more stackable window. And by combining these strategies, you can equip yourself with the tools to generate income and profit from the consolidation, okay? Covering a much wider range of market behaviors and profiting from the market. So we've explored the mechanics, the risks, the benefits, how the Iron Condor works, how the covered call works. If you want to learn more about options, head over to stackmode.net. Stay prayed up to God. Keep grinding. Catch you in the next one.